In this video, we'll show you 3 unstoppable tech stocks trading under $15 that are quietly taking market share from billion-dollar giants. By the end of this video, you will understand how these under-the-radar companies are positioning themselves to dominate critical parts of the global tech ecosystem and why their current valuations may not reflect their true long-term potential. Each of these businesses operates in industries that are becoming more essential every single year. They are building solutions that enterprises depend on, embedding themselves into workflows that are difficult to replace, and creating systems that scale with minimal incremental cost. That combination is exactly what drives long-term compounding, and right now, the market is still pricing them like small players. Let's start with the first company. UiPath, ticker symbol PATH, is not just another software company. It sits at the center of one of the most important shifts happening in enterprise technology right now, which is automation. Every large organization today is dealing with the same problem: too many repetitive tasks, too much manual work, and too much inefficiency hidden inside everyday processes. Think about invoice processing, data entry, compliance checks, customer onboarding, and thousands of other workflows that still require human input even though they follow predictable patterns. UiPath is solving that problem with robotic process automation, also known as RPA, but calling it just RPA actually undersells what the company is doing today. UiPath has evolved into a full automation platform. It combines software robots, artificial intelligence, and analytics into a system that allows companies to automate complex workflows end to end. This means businesses are not just saving time, they are fundamentally redesigning how work gets done. And this is where the moat starts to become clear. Once a company builds its operations around UiPath's platform, switching becomes extremely difficult. You are not just replacing software, you are rebuilding entire workflows, retraining teams, and reconfiguring systems that are deeply embedded into your operations. That creates high switching costs, which is one of the strongest forms of competitive advantage in software. Now layer on top of that the scale advantage. UiPath has built one of the largest automation ecosystems in the world. It has a global customer base that spans industries like finance, healthcare, manufacturing, and government. The more customers it serves, the more data it collects, and the more it improves its automation capabilities. That creates a feedback loop that smaller competitors struggle to replicate. But here is where things get even more interesting. Automation is no longer just about saving costs. It is becoming a strategic necessity. Companies are facing labor shortages, rising costs, and increasing pressure to operate more efficiently. At the same time, AI is unlocking new possibilities for what can be automated. UiPath is right at the intersection of these trends. The company has been integrating artificial intelligence into its platform, allowing its software robots to handle more complex, unstructured tasks. This expands the total addressable market significantly. Instead of just automating simple processes, UiPath can now tackle workflows that previously required human judgment, and that is a massive opportunity. When you look at the numbers, you start to see the early signs of this shift. UiPath has built a recurring revenue model that provides strong visibility into future growth. Its annual recurring revenue has been growing as more customers adopt its platform and expand their usage over time. This land and expand strategy is powerful because once a company starts using UiPath, it often increases its automation footprint across multiple departments. The company also benefits from strong gross margins, which is typical for software businesses. This means that as revenue grows, a larger portion of that revenue can eventually translate into profit. At the same time, UiPath has been focusing on improving its operating efficiency. Like many tech companies, it went through a phase of heavy investment to capture market share. Now it is shifting toward a more balanced approach that prioritizes sustainable growth and profitability, and this is where the disconnect in the market comes in. Despite its leadership position in automation and its expanding capabilities in AI, UiPath's stock is still trading at a relatively low price compared to many other software companies. The market has been cautious due to broader concerns around tech valuations and growth rates. But if you step back and look at the bigger picture, the long-term demand for automation is not going away. If anything, it is accelerating. Companies are not going to suddenly stop trying to reduce costs and increase efficiency. They are not going to abandon automation after investing millions into it. And they are certainly not going to ignore the potential of AI to transform their operations. UiPath is positioned right in the middle of all of this. Now think about what happens over the next 5 to 10 years. As more businesses adopt automation, as AI becomes more integrated into workflows, and as digital transformation continues across industries, UiPath's platform becomes more valuable. its customer relationships deepen, its data advantage grows, and its ability to deliver value increases. This is how small companies become dominant players. They start by solving a specific problem. They build a strong product. They expand their capabilities. And over time, they become essential to their customers. UiPath is already on that path, and yet it is still trading under $15. That is the kind of disconnect that long-term investors look for. Because when a company with strong fundamentals, a growing market, and a clear competitive advantage is priced like a small player, it creates an opportunity. But of course, no investment is without risk. UiPath operates in a competitive space. Larger companies are also investing in automation and AI. The pace of innovation is rapid, which means UiPath needs to continue executing at a high level to maintain its leadership position. There is also the question of growth expectations. The market often expects high growth from tech companies, and any slowdown can impact the stock price in the short term. But if you focus on the long-term trends, the picture becomes clearer. Automation is becoming a core part of how businesses operate. AI is expanding what is possible, and companies that can combine these technologies into a scalable platform are likely to capture significant value. UiPath is one of those companies. It is not just participating in the automation trend, it is helping define it, and that is why it stands out as one of the most interesting tech stocks under $15 right now. If this resonates with you, you're exactly who this channel is for. Please hit the like button, share the video, and leave your thoughts in the comments. Subscribe to the channel so you don't miss out on the next important financial investing update. Remember to do your own research before you invest in any stock. Now let's move on to the second company. The second company is operating in a space that most investors are still underestimating, even though it sits right at the center of global security, data intelligence, and infrastructure protection. Gorilla Technology Group, ticker symbol GRRR, is not trying to compete with traditional software companies. It is building intelligent systems that help governments and enterprises make real-time decisions using massive amounts of data. To understand why this matters, you need to look at how the world is changing. Cities are getting smarter, infrastructure is becoming more connected, surveillance systems are generating enormous volumes of video and data every second. At the same time, threats are becoming more complex, whether it is cyber threats, physical security risks, or operational inefficiencies. The problem is not a lack of data. The problem is making sense of it fast enough to act. That is exactly where Gorilla Technology comes in. The company specializes in AI-driven video analytics, cybersecurity, and IoT-based solutions. Its platforms are designed to process large-scale data streams in real time and turn them into actionable insights. This allows organizations to detect anomalies, respond to threats, and optimize operations without relying on manual monitoring, and this is where the real advantage starts to show. Unlike traditional systems that simply record or store data, Gorilla's technology actively interprets what is happening. It can identify patterns, flag unusual behavior, and provide alerts instantly. In environments like smart cities, transportation networks, and critical infrastructure, that capability is incredibly valuable. Because in those settings, timing is everything. If a system can detect a security risk or operational issue even a few seconds earlier, it can prevent significant damage or loss. That is not just a convenience. That is a necessity. Now let's talk about the market opportunity. The global push towards smart cities and digital infrastructure is accelerating. Governments around the world are investing heavily in technologies that improve safety, efficiency, and sustainability. This includes surveillance systems, traffic management, energy optimization, and public safety solutions. Gorilla Technology is positioned right in the middle of this trend. The company has been securing contracts and partnerships that allow it to deploy its solutions at scale. These are not one-time transactions. They often involve long-term implementations, ongoing support, and system upgrades. That creates recurring revenue opportunities and deeper relationships with clients. Another important factor is the complexity of these systems. Once Gorilla's technology is integrated into a city's infrastructure or an enterprise's operations, it becomes difficult to replace. Similar to UiPath, this creates high switching costs. You are not just swapping out software, you are replacing a critical layer of intelligence that is deeply embedded into your systems. That is a powerful moat. Now, from a financial perspective, Gorilla Technology is still in an earlier stage compared to larger tech companies. It is focused on expanding its footprint, building out its capabilities, and capturing market share in a rapidly growing industry. This means the company may not yet have the same level of profitability as more mature businesses, but that is often the trade-off with high-growth opportunities. You are looking at a company that is investing heavily today to position itself for much larger revenue streams in the future. And when you look at the broader trends, that strategy starts to make sense. Data is growing exponentially. The need for real-time analytics is increasing. Security concerns are becoming more urgent, and the integration of AI into infrastructure is no longer optional, it is becoming standard. Guerrilla technology is aligning itself with all of these trends, but here is where the opportunity becomes interesting for investors. Despite operating in a high-growth space with significant long-term potential, the stock is still trading under $15. That reflects both the risks and the early-stage nature of the business, but it also means the market may not fully appreciate what the company could become if it executes successfully. This is not a guaranteed outcome. Execution matters. The company needs to continue securing contracts, delivering results for its clients, and scaling its operations efficiently. It also needs to navigate competition from other players in the AI and analytics space. But if it can do that, the upside could be substantial. Because the markets it is targeting are not small. Smart cities alone represent a multi-billion-dollar opportunity. Add in cybersecurity, IoT analytics, and infrastructure intelligence, and you start to see the scale of what Guerrilla technology is aiming for. And unlike many companies that are trying to find their place in the AI ecosystem, Guerrilla already has a clear use case. It is not building AI for the sake of AI. It is applying it to real-world problems that organizations are actively trying to solve. That distinction matters, because companies that deliver tangible value are the ones that tend to survive and grow over time. Now, when you compare Guerrilla technology to billion-dollar giants, the difference in size is obvious. But size does not always determine performance. Smaller companies can move faster, they can innovate more quickly, they can focus on niche markets that larger companies overlook, and in some cases they can outperform much larger competitors by being more specialized and more agile. That is the potential here. Guerrilla technology is not trying to be everything to everyone. It is focusing on specific areas where it can deliver high-impact solutions and build strong positions. If it succeeds, the gap between its current valuation and its long-term potential could close in a significant way. And that is exactly the kind of setup that investors look for when searching for high-upside opportunities. This video is brought to you by Value Stocks Investing Master Course. If you're looking to grow your wealth by investing in solid, undervalued stocks but not sure where to start, I created the Value Stocks Investing Master Course to teach you how to identify great companies, make smart investment decisions, and build a portfolio that lasts. Click the link in the description and pinned comments to get the course today and take control of your financial future. Now let's move on to the third and final company. This company is operating in a part of the economy that almost nobody thinks about, yet it touches some of the most critical infrastructure in the world. Duos Technologies Group, ticker symbol DUOT, is focused on rail, logistics, and infrastructure inspection. At first glance, that might not sound like a high-growth tech story, but when you look closer, you start to realize this is exactly the kind of overlooked niche where small companies can quietly build massive value. Rail networks are the backbone of freight transportation. They move raw materials, consumer goods, energy resources, and industrial products across entire countries. Every day, thousands of trains travel across vast networks carrying billions of dollars worth of cargo. Now think about the scale of that system, and then think about the risk. A single failure in a rail system can cause massive disruptions. It can delay shipments, damage goods, and in some cases, create serious safety hazards. That is why inspection and monitoring are so important. Traditionally, a lot of this inspection work has been manual. Human inspectors checking rail cars, scanning for defects, and trying to catch issues before they become problems. But manual inspection is time-consuming, expensive, and not always reliable. This is where Duos Technologies comes in. The company has developed intelligent inspection systems that use high-speed imaging, sensors, and artificial intelligence to analyze railcars in real time. As trains move through inspection portals, Duos' technology captures detailed data and identifies potential issues instantly. This includes things like structural defects, mechanical problems, and safety concerns that might not be visible to the human eye. The value proposition is simple but powerful. Faster inspections, more accurate results, lower costs, and improved safety. For rail operators, that combination is extremely compelling, because every minute a train is delayed costs money, every missed defect increases risk, and every inefficiency adds up over time. By automating and enhancing the inspection process, Duos is helping rail companies operate more efficiently while reducing the likelihood of costly failures. Now let's talk about the competitive advantage. Duos is not just selling a product, it is providing a system that integrates into the core operations of its customers. Once installed, these inspection portals become a critical part of the rail network's workflow. Similar to the other companies we discussed, this creates switching costs. Replacing Duos' system would require not just new technology, but also changes to infrastructure, processes, and data integration. That makes it more likely that customers will continue using and expanding the system over time. Another key factor is the data. As DUOT's systems are deployed across more locations, the company collects increasing amounts of data on railcar conditions and performance. This data can be used to improve its algorithms, enhance predictive capabilities, and deliver even more value to customers. Over time, this creates a feedback loop. Better data leads to better insights lead to better performance. And better performance strengthens the company's position in the market. Now let's look at the growth drivers. Rail infrastructure is aging in many parts of the world. At the same time, demand for freight transportation continues to grow. This creates a need for more efficient, reliable, and scalable inspection solutions. On top of that, there is increasing regulatory pressure around safety and compliance. Governments and industry bodies are pushing for higher standards, which means rail operators need better tools to monitor and maintain their systems. DUOT is directly aligned with these trends. The company has been expanding its deployments and working on increasing the number of inspection portals in operation. Each new installation not only generates revenue but also strengthens its presence in the market. From a financial perspective, DUOT is still in a growth phase. It is investing in expanding its technology, scaling its operations, and capturing more opportunities in the rail and logistics sector. This means the company may not yet have the same level of profitability as larger, more established firms. But again, that is often where the opportunity lies. The market tends to focus heavily on current earnings, especially for smaller companies. But for businesses that are building long-term value in growing industries, the real story is often in the future potential. And that is exactly what we are seeing here. DUOT is addressing a real problem in a critical industry. It has a technology-driven solution that delivers clear benefits. And it is operating in a market with strong long-term demand. Yet the stock is still trading under $15. That creates an interesting dynamic. On one hand, there are risks. The company needs to continue executing, securing contracts, and scaling its deployments. It also needs to manage costs and move toward profitability over time. On the other hand, there is significant upside if it succeeds, because the more its systems are adopted, the more embedded it becomes in the rail ecosystem. And the more embedded it becomes, the harder it is to replace. This is how small, specialized companies can build durable advantages over time. They focus on a specific problem, they solve it better than anyone else, and they become essential to their customers. DUOT Technologies is following that playbook. Now, when you step back and look at all three companies we have discussed, a pattern starts to emerge. UiPath is transforming how businesses operate through automation and AI. Guerrilla Technology is enabling real-time intelligence in smart infrastructure and security. DUOT Technologies is modernizing critical inspection processes in rail and logistics. Different industries, different applications, but the same underlying theme. Each company is using technology to solve real, high-value problems. Each one is building systems that become deeply integrated into their customers' operations. And each one has the potential to scale significantly as demand for their solutions grows. That is what makes them interesting, not just because they are trading under $15, but because they are operating in areas where long-term demand is strong and likely to increase over time. Of course, investing in smaller companies comes with higher risk. These businesses are still growing. They are still proving themselves. And their stock prices can be more volatile compared to larger established companies. But with higher risk can come higher reward. The key is understanding what you are investing in. Are these companies solving real problems? Do they have a competitive advantage? Are they positioned in growing markets? If the answer to those questions is yes, then they are at least worth a closer look. Because sometimes the biggest opportunities are not in the companies that everyone is already talking about. They are in the ones that are still flying under the radar. If you want exclusive stock tips, in-depth analysis, real-time trade alerts, and free investing guides, join the Stocks Galore Patreon today and take your investing game to the next level. Our members get full in-depth analysis on most of the stocks mentioned here. Head over to patreon.com/stocksgalore and become part of our growing community of smart investors. Link is in the description. Now here is a question for you. Which of these three companies do you think has the strongest long-term competitive advantage, and why? Is it the automation platform of UiPath, the AI-driven infrastructure intelligence of Guerrilla Technology, or the rail inspection systems of DUOT Technologies? Let me know your thoughts in the comments below. Do not forget to like the video, share your thoughts in the comments, and subscribe so you do not miss the next important investing update. Thanks for watching, and I will see you in the next one.